Hi, I'm Alex. I run a small but growing company, and I've just landed my first sale into the EU. My customer asked about VAT, and honestly, I don't get it. Isn't this just like sales tax?
Hi Alex, welcome to VAT 360 Learn. In this first module, we'll explore a simple but fundamental question. What is VAT really? And to make it practical, we'll follow Alex, an SME founder who's just made his first sale into Europe. I am Peter, and I have extensive experience managing VAT compliance and advising businesses on how to travel the bumpy road of global VAT compliance. So Alex, let me guide you along the way, as your questions and challenges are identical to many businesses and professionals doing business cross borders. In the next 10 minutes, we'll break down what VAT is, how it works, and why it's different from sales tax. In this short module, we'll start by breaking down what VAT actually is, not just the acronym, but the core concept. Then we'll look at how VAT flows through a typical supply chain and how the deduction of input tax ensures the system stays tax neutral for businesses. From there, we'll highlight some key differences between VAT and sales tax, especially relevant if you're used to US systems. Finally, we'll wrap up with a high-level explanation of the destination and origin principles, a crucial concept for understanding VAT on cross-border transactions. By the end of this module, you'll be able to explain what VAT is and how it works across the supply chain. You'll understand the difference between input and output VAT and how businesses recover the tax they pay. And finally, you'll be able to describe how VAT differs from sales tax and what the destination principle means in cross-border trade.
So, what is VAT exactly? Do I have to pay it myself?
VAT is also called VAT, and it stands for Value Added Tax. And as it is a consumption tax, and not a tax on income or property, it aims to tax consumption. It's an indirect tax applied to most goods and services. And here's the key. VAT is ultimately paid by the final consumer, not by businesses. This is also why it's called an indirect tax, which means that although businesses collect and pay it to the government, the actual cost is passed on to the final consumer. Your role, Alex, like every business in the chain, is to collect VAT on sales and reclaim VAT you've paid on purchases.
Oh, so I'm like a tax collector for the government?
Exactly, Alex. Think of it this way. As a business, you're the collector. You charge VAT on your sales and pass it to the tax authorities. But the end consumer is the one who really pays. When you or I buy something as a private consumer, the VAT has already been added step by step along the supply chain. The beauty of the system is that it's neutral. No matter how many companies were involved, the total VAT the consumer pays at the end is always the same. And here's an important twist. Exports are usually zero rated. No VAT is charged when goods or services are sold outside the EU, but imports into the EU are taxed. That way, local businesses aren't put at a disadvantage. It keeps the playing field fair. This map gives you a global view of just how widespread VAT systems are. Every country in dark blue has adopted VAT. That's more than 170 countries, covering most of Europe, Asia, Latin America, and Africa. The countries in lighter blue, like the United States, don't have VAT. Instead, they typically use sales tax at the state or local level, a very different system, as we'll discuss later. And finally, some countries have not implemented a consumption tax like VAT or sales tax.
But wait, if everyone charges VAT along the way, doesn't that mean double or even triple taxation?
Good observation, Alex. You're right. If every business charged VAT without a system in place, we'd end up with double or even triple taxation. But here's the safeguard. Input VAT. Businesses can deduct the VAT they've already paid. So in the end, only the value they add gets taxed. That's why it's called a value-added tax. Let's walk you through a simple example using coffee. from farmer to consumer with a flat 10% VAT rate. To keep it clear, we'll ignore currency differences. Step 1. The farmer. A farmer in Colombia sells green beans to a trader in Europe for $100. Because it's an export, no VAT is charged. Exports are usually zero rated. Step 2. The importer. The trader imports the beans into France. At import, VAT kicks in, €10 on the $100 value. But since the trader is VAT registered, he reclaims that €10 as input VAT. Net effect? Zero. Step 3. The wholesaler. The trader sells the beans to a French wholesaler for €300, charging €30 VAT. The wholesaler pays it, but can reclaim it later. Here's the key. The wholesaler adds €200 in value, he buys for $300 and sells for $500. On that sale, he charges €50 VAT, then deducts the €30 input VAT he already paid, net VAT due, €20, which is exactly 10% of the €200 value he added. Step 4. The cafe. The wholesaler sells the roasted coffee to a cafe for €500 plus €50 VAT. The cafe then sells cups of coffee to consumers for €1,000 plus €100 VAT. They deduct the €50 input VAT they paid, leaving €50 payable to the tax office. Final outcome, the consumer. The consumers pay €1,100 in total, €1,000 for the coffee plus €100 VAT. That €100 is the same amount collected along the entire chain, step by step, as value was added. And that's the essence of VAT. Every business is taxed only on the value it adds. The final burden always falls on the consumer. In the previous slide, we introduced the core VAT concepts, input VAT and output VAT. But how does this work in practice? How does VAT get recorded, tracked, and reported? The key document that ties it all together is the invoice. It's the financial link between buyer and seller and the basis for VAT compliance. Let's revisit our example, where we zoom in on the transaction between the trader and the wholesaler. The trader sells the coffee to the wholesaler for €300 plus €30 VAT. On his outgoing invoice, he records €300 as sales revenue and €30 as output VAT owed to the tax authority. At the end of the month, when preparing his VAT return, the trader reports €30 of output VAT from the sale and €0 of input VAT, assuming he made no other cost in April, resulting in €30 net VAT payable to the tax administration. Now let's look at the wholesaler. He received that same invoice from the trader. In his accounts, the €30 VAT is recorded as input VAT. Later, he sells the coffee to a cafe for €500 plus €50 VAT. So at month end, he reports €50 of output VAT from his sale and €30 of input VAT from the trader's invoice, resulting in €20 net VAT payable. As you can see, each party calculates VAT only on the value they added, and the system works smoothly because of one thing: clear invoicing and accurate VAT returns.
I'm from the US. This still feels a lot like sales tax to me. What's the difference?
Here's the big difference. While both are forms of consumption tax, they work in very different ways. Sales tax is only charged once, at the point of sale to the final consumer, typically at the cash register. Businesses earlier in the chain don't deal with it at all. But VAT works differently. As discussed in the slides before, VAT is collected at every stage of the supply chain, from the manufacturer to the wholesaler and retailer. Each charges VAT on their sales and deducts VAT on their purchases. In a VAT system, businesses act as tax collectors throughout the supply chain, but they're only taxed on the value they add. For consumers, a noticeable difference between the two systems is that consumer pricing in VAT countries includes the VAT that the consumer must pay, while consumer pricing in the US is exclusive of state or local sales tax. Here's another key point. In a sales tax system, businesses typically can't recover the tax paid on purchases, which becomes a cost unless they qualify for exemptions. In contrast, in VAT systems, as long as you're registered, compliant, and perform taxable supplies, you reclaim the VAT you pay on business expenses. So, even though both aim to tax final consumption, they follow very different mechanics, and that matters when doing business internationally. The takeaway? VAT is broader, more integrated into business operations, and it shows up well before the final sale.
All right. But if I sell from Germany to a customer in France, who gets the tax? Germany or France?
Thanks for raising that question, Alex, as this is a great scenario to explain the destination versus the origin principle. Under the origin principle, the seller's country keeps the tax, but VAT often follows the destination principle, resulting in the buyer's country getting the tax. This approach helps create a level playing field. Whether a product is bought locally or in another country, it's taxed in the same way. It also explains why exports are zero-rated under VAT rules, because the goods are consumed outside the seller's country and the VAT belongs elsewhere. So in your case, Alex, France, where the product is consumed, gets the VAT. This keeps trade fair and avoids double or no taxation. To recap, VAT is a multi-stage consumption tax collected throughout the supply chain, but ultimately paid by the final consumer. Businesses collect VAT on sales and reclaim it on purchases, ensuring tax neutrality. And in international trade, most VAT systems apply the destination principle, taxing goods where they are consumed, not where they are sold. These fundamentals are key to understanding how VAT works and why it matters in global business. That brings us to the end of the first module of our free 3-part introduction to VAT. You now understand what VAT is, how it flows through a supply chain, and how it differs from systems like sales tax. In the next modules, we'll build on this foundation, exploring VAT registration, invoicing, reclaim rules, and common risks in real-world business scenarios. Thanks for watching. Click the button below to continue your VAT journey with free access to modules 2 and 3. Have questions, feedback, or want to explore how VAT 360 can support your team or organization? I'd love to hear from you. You'll find contact details and useful links on the screen now.